Ah, let's get this secret out. Okay, let's get this secret out. So in this video, I'm going to be showing you how to flip small forex account, and this is how I did, and I've also taught most of my mentees on how to do this. Yesterday we stopped off at $711. I made $300 to $711. Flipping small account is not something new. It's something that you guys have probably been conversant with, maybe from other forex YouTube mentors. But here I'm about to divulge the secret to you guys. Forex account flipping, also known as overnight trading or scalping. I mean, some other traders also do this flipping. You can do it with swinging, but most times it's done by scalping. So it's also known as scalping. It's a way of actually taking advantage of smaller moves in the forex market in order to make tangible profits. The goal is to open and close position within a short time frame. It can even be within hour or few minutes in order for you to make profit in the shortest time possible. While flipping accounts can be so profitable and very attractive to many newbie traders and many advanced traders, I mean, it's highly risky. So that's why I'm making this video, so you can understand the risk that is involved and how to better handle it if you want to actually venture into this type of account flipping. Say, for example, you funded an account of $50 and you intend on flipping that $50 to about 100% in a day. It is possible with forex trading. So that's what we call account flipping. You can even do way more. So making your $50 to be $100 is pretty simple when you actually know these rules I'm about to explain to you. So number one rule that you have to put into perspective is high leverage. Forex account flipping always involve high leverage, which can actually amplify losses and also amplify wins. Now, what's leverage? Leverage is an amount of money that your broker lends to you in order for you to trade at that particular time. Once that trading is over, they have to pull out their leverage and then hold on until you place the next trade, and then they release the leverage again to you. So we have leverage ranging from 1 to 10, 1 to 50, 1 to 2,000, 1 to 1,000, 1 to 500. Now, what is the ideal leverage you want to choose for your $50 account or small account? The ideal leverage just depends on you and what you want to achieve with it. But the rule of thumb is if you are trading a small account, you want to choose a very big leverage so that you have more money in order for you to trade in a bigger account. What this simply means in reality is if you deposit $50, it's going to be $50 times 50 if you choose a leverage of 1 to 50. Now, if you choose a leverage of 1 to 100, on your $50, it's going to be $50 times 100. Though you have $50 in your main account balance to trade, but however, your buying capacity can range up onto 100 times 50, which is $5,000. With your $50 account, you can place trade of up onto 5,000 US dollars when you choose a leverage of 1 to 100. But what happens when you choose a leverage of 1 to 1,000? That simply means you have a buying capacity of 50,000 US dollars. And if you choose a leverage of 1 to 2,000, with your $50, you're still going to be having a buying capacity of $100,000. That's the interesting part. But what if it is whipsawing going against you? Also, the losses is also going to be amplified. That's why so many forex traders has a misconception that leverage is a bad thing. No, it's not. It's just like having a Lamborghini. If you know when to apply brakes, as at when you definitely you'll be able to know how to use bigger leverage and apply your stop loss when due. So if you're trading a small account, I mean, it's a flipping account. You're always expecting the worst to happen most of the time. So if you are doing that, you make sure you have to use a very high leverage. Another secret you need to know about flipping small forex accounts is volatility. They have to put this into perspective. Volatility is one of the biggest things that you have to put into concept because forex is already known for its high volatility. But however, there are some sessions that are more volatile than some other. So you want to be playing in a session where the volatility is much because you want to hop on trade and get your result instantly. You don't want to hop on a snail market where market is moving sluggishly. Then you hop on, you keep waiting, and it's making you to panic really hard. So that's why each session that you are trading in really matters most. So the busiest session is always overlap session, where London meets with New York. But the biggest, again, is London session. And the second biggest is New York session. This is the time you want to be playing around. So if you're in Nigeria, just like I am, I'm making video right now in Lagos, Nigeria. And if you like my videos, please kindly subscribe and turn on post notification. Also smash the like button so that this video can be recommended to as many people. So if you're in Lagos, Nigeria, the time right now is GMT +1. What that simply means is in London, right now, of making this video in February, we are 1 hour ahead of London. So London session starts by 9 a.m. Nigerian time. And New York session also starts by 2 p.m. Nigerian time. So you have to put this time into perspective. And overlap also happen between 2 p.m. to about 4 p.m. Nigerian time or 5 p.m. Nigerian time. So this is the time you want to be trading. So actually, we in West Africa we have a perfect timing to be trading this forex market because it happens exactly our daytime to evening. So you can actually be trading. That's a volatile time. So you don't have a problem with that. If you have a small account, you have to make sure you are trading between 8 a.m. Nigerian time up until 5 p.m. Nigerian time, because that's when the volume and the volatility is actually in market. Whenever you place a trade, you get to see your result in time, and there's no dull moment. Another secret you have to understand by flipping a small account is spreads. If you're trading a small account, you don't want to open an account that has a very wide spread. So that's why it's important you work with a broker with a very tight spread. So that's why I'm recommending Xness. Check the link in the description below and sign up with Xness. That's also the account I'm also using to flip. Now, with spreads, I mean, you don't want to be paying too much in commissions. You don't want to be paying too much in spread. So the difference between your bid and ask price has to be very tight because you're trading a small account. So you want to click buy, and then in no time you should be in profit when markets start moving in your direction, or click sell, in no time you should be in profit when markets start moving in your direction. So you have to look for a brokerage with a tight spread. Most times, in order for you to come out really successful in forex trading, you need to click buy or sell and immediately be in profit, and then use the profit, unrealized profit, to start making more money while they are staying in the market. So there are a lot of tactics around that. So if you think you've heard it all, it's not all. Don't click out of this video until you listen to the next point. This next point is the whole brain behind this video, which is position size calculator for small accounts. In order for you to trade a small account, you don't want to be risking all the account all at once. Yes, it's a small account. I mean, it's just $50, it's just $100, it's just $2, it's just $1, or any amount of money you intend to flip. But my advice is, do not risk everything all at once. Here's my strategy that I use in risk size. All I want to do is I want to either risk 50% of the account at a time, or I'm going to split it to 25% at a time. Say, for example, I'm trading an account of $50, since that's the example we'll be using from onset. So I'm going to go ahead and risk 50% of it because it's a small account. I mean, for someone who's trading $50 account, you should be willing to want to risk everything. But do not risk everything all at once. Start with 50% of it. That's risking $25 at a time. So when you're risking $25, all you have to do is go to your position size calculator and impute 50% risk percentage, and then you put your stop loss, and then this position size calculator is going to give you the loss size to use. Say, for example, it's telling us to use 0.02. So I'm just going to go ahead on my MetaTrader 4 and click 0.002, and then either buy or sell, depending on my analysis at that time. If the trade is going against me, because we're talking about risk management, what things go south, not if it goes well. If the trade is going against me, do you know what I'm going to do? I'm just going to hold on until it's either move in my favor or just try to give me a very good weak rejection, and then I'm still going to hold on. I don't add position not until that first entry is in profit. Once that first entry gets into profit, immediately I'm going to tighten my stop loss, and then I'm going to get in around that lot size. Then I'm no longer risking 50% again. Now the risk becomes higher. You know what is helping me? Because of the unrealized profit that I'm yet to close out in my equity. That's what I'm using to place new trade. Because if I'm making profit, my balance still remains the same thing. Equity is calculating that profit that I'm making. However, my free margin keeps increasing. So when my free margin keeps increasing, then I can go ahead and even still place more trade depending on the leverage which I have. So that is the benefit of proper position size calculator, understanding what free margin is, equity is, your balance is, margin is, and margin level percentage is. Then the next point, which I'm going to be taking you to, is also going to blow your mind on how to avoid margin calls. The next point is margin calls. Margin call occurs when a particular trader's account is dropping below some certain percent level. Most of the time, it shouldn't go below 100%. Right now, go on your MT4, MT5 and go check if you're on any trade, how many percentage your margin level percentage is at. So if it is below 100% with most brokers, that is a red flag. So what they are going to do whenever you have a margin call is they're going to check through your orders, your positions that are currently open. They are going to close out first with the one with the biggest loss. Say, for example, you have a trade on GBP USD about 3 positions. There's one that is minus $50, and the other one that is minus $2. The other one is minus $1. Do you know what they're going to close out first? They're going to close out the one of minus $50 first. That's how the rule just works. Now, in order for you to prevent yourself from that, is you have to really understand how leverage works, how your free margin works, and in order for you not to place too much trade, there has to be a limit. You don't keep placing trade when your free margin level is really dropping. You don't keep placing trade. When that is happening, when you keep placing trade, you are calling for a margin call because you don't have enough money to hold your drawdown whenever price start pushing down. So it's a real calculation that you have to really sit down and say, how many trade do I need to place here in order for me not to have margin call? Or what would be too much trade? because you want to try to avoid margin calls. So those are the things you put into perspective in order for you to learn how to flip account. This is the actual secret. I'm not even hiding anything from you guys, but this is the actual secret to flipping a small account to something really tangible. So you really have to sit down, do your pure calculation. Now, if you're able to have a hinge of this, then you know that flipping is not total risk. It's something that you already know how to do. You master it, and then you'll be able to do it over and over and over again. It's not luck, it's mastery. And then here's the bonus point for those that stay up to this extent. That is market conditions. Market condition also determine when you should be flipping account. You don't want to be flipping account when markets are really shabby, maybe like Russian-Ukraine war or times that are very unstable when you don't really understand the Forex market. Most times I flip when I have winning streaks. If I've studied that my last week was really good, then the next week is a very good time for me to start flipping because I understand the current market condition. Now, if you don't understand the Forex current market condition, that's not a bad thing. It happens every time. You must know how the current market conditions are working. So it is fine. Just sit down, study, do your back test. And however, if you know the current market condition, man, don't sleep on it. It's the best time to make increase load of money if you really know how to trade. And if you don't know how to trade, or if you don't know how to flip, follow the steps that I listed above, and you definitely will know how to flip. So that's how I do it, and you guys should also be doing. That's why Shams, my student, he flips $0 to $600 in 1 day. It's no joke. It was a bonus account that he had. So he had $27 as a bonus, but the account balance was reflecting zero. So he was able to place one trade, and then that moved in his favor. From there, he kept adding new positions, kept adding new positions. It was because he understood these things that I just listed out to you guys. That's how he was able to make this much money. Now, if you guys are able to also follow suit with this thing, trust me, you guys will also be making crazy money. And please always kindly note that all these things I've told you guys, no financial advice. Also do your own personal research, and it's something I also did my personal research. That's what has landed me this far. All right, until next time, if you liked my video, please kindly make sure you watch these other ones and like, subscribe, and turn on post notification. Bye for now, guys. You guys are the best. Bye.